Welcome to Excitant Fiber's second capital raise session. In this session, we introduced our newest board member, Hal Brumfield, founder of Tachus, a regionally leading name with over 50,000 subscriptions. We discussed key opportunities in the market investor potential, our projection model, capital requirements, and valuation. Additionally, we answered investor questions and gathered valuable feedback from our experienced participants.
Okay, everybody, thank you all for joining. We still got some more people going to join here shortly, but I know we've all spoken of the recent days and weeks, and so I appreciate y'all making time today. And we've spoke about it. I wanted to make sure and talk about and introduce Hal Brumfield as joining the Excitant board. We spoke about a story. Hal will speak about that in a minute, and we'll give you the details of Excitant Fiber and why we're so excited to be doing this today, and why we're so excited to be putting fiber in the ground as soon as possible. But at that point, y'all all heard me talk quite a bit on this, so I'm not going to speak a lot today, hopefully. Hal, I'm going to introduce you over. Just to make sure everybody knows everybody in the room here. Hal's here to my left, Cody Landrum to my right, and then John Dennis of Woodrock Capital as well. And then we have James Musgrove that's helping us with the tech side of this today. But I'm going to turn it over to Hal here, and he's going to tell us his past, his experience, why he decided to join Excitant Fiber, and his vision for it with Cody's, how it aligns with Cody's. Hal, over to you, man.
Yeah, sure.
Okay.
Some of you may or may not have heard of a company called Tachus, but I founded Tachus back in 2015, and grew it to just shy of 200,000 passings, and had an exit there, or actually parted ways in June. Through a mutual friend who introduced us, introduced me to Cody and Justin, we ended up here today. So I'm excited about the opportunity. It reminds me, some of the things that I've seen thus far. Looks a lot like the early days of Tachus, there was some extreme success there, while that grew from nothing to what it is today.
So, and how how many subscribers was Tachus at when you left?
So it was 50,000, just shy of 50,000, but a lot of the network was fairly young. I think 2/3 of the network was less than 18 months old, so there's still a lot of runway there.
Yeah. And Hal, what's your, you said this aligns with a lot of what you do within Tachus, Excitant does here, but how do you see this vision carrying forward in Excitant Fiber that Cody has, that we have, and others' experiences align, man?
I look at the areas that they've identified, and work with Cody and Justin to identify some additional areas. You look at density of homes that don't have fiber, that have a really bad cable competitor, and that's what I've seen is the opportunity in these tertiary markets. I can say that I cut my teeth early in the late 90s at a dial-up in ISP, and it was a very similar growth pattern to what this looks like. Back then, it grew from, I was employee maybe number 30. We grew to about 400 total employees in about 2 years. We went public on the NASDAQ and ended up selling for $2.1 billion. And I got exactly zero of that money because I was just a worker bee at that point. But it was a fun ride while I was there, and that was really focused on doing these tertiary markets where you go and you build the market and you basically own the market. I don't see any reason why these markets should see any less than 60-70% uptake, because they don't have any other options. It just, I've seen this movie before, and I know how it ends, and it looks really good.
And speak to the audience here a little bit on this, is that where Cody's experience and what he did in Crystal Beach with his previous company before he sold it was more rural. With Hal's experience, it's more suburban area, and so those two complement each other, and so we found a lot of confidence already and a lot of synergy in bringing these two together. We've had successful careers and paths and starting fiber businesses and growing them from day one, from zero. So there's a lot of synergy there. Our Exciting Fiber's focus has been on more rural areas because there's nobody there. There's low hanging fruit. There is no competition. And that's where Cody's had vast experience at, and Hal complements that as well. As a valid point here. Would you agree, John? So
yeah, rural and as you call them, tertiary markets. These are rural or smaller suburban markets, or suburban markets in smaller towns. And I think that that's just a great differentiator from the Tachus plan, which is more city centric and trying to create a donut around the city. This is a way where you're simply capturing these lower density, but basically unserved markets all over East Texas and Central Texas. And the opportunity is vast.
for sure. I was going to ask you another question for you. I mean, when you said you're at 50,000 subscribers of Tachus, what kind of, market valuation do you think they'd put on that today from this, what you know out there in your experience?
I know these companies are trading, plus or minus 10,500 per passing, 3,000, I'm sorry, inverse, 3,000 per passing and about 10,500 per lit home.
Right.
So, rough math, it's Tachus at, plus or minus $500 million valuation.
Yeah. And Cody, I'm going to turn it over to you in a minute. Our plan is to raise the initial 6 million. We've got, softly about half of that raise right now, and is to get that first 6 million raised, and then we'll do another raise after about 12 months, I believe is what we're showing here. And then in 18 months, we're forecasting to be at 10,000 subscribers, which would be at a similar valuation metric number. Okay. Some of y'all heard from Cody in the past, some of you have not. So at this point, I'm gonna give Cody's the mic and let him speak about his experience, how he started out in Crystal Beach and what he saw, because it's similar to Hal's, but it's different because Cody started this from grassroots, whereas Hal was able to be blessed enough to get capital from a firm. They gave more than he asked for, or 20 times more than he asked for, probably, give or take, right? Give or take.
Yeah, I mean, in the aggregate, it was what we were looking for, but
Right.
we'd initially gone in and looked at project financing, where we're going to do one neighborhood or one area, and then we ended up raising the capital to do all of it.
Right. But Cody, I wanted you to turn it over to you so you can speak about how you started in the past and how you go through the quick story so everybody here knows it. Okay.
Sure. So Cody Landrum, in 2015, like Hal's story, I started an ISP in Crystal Beach, which is southwest of Beaumont, for anybody that doesn't know, near Galveston Island. And it started from me needing my own internet, and I couldn't figure out how to fix my internet without fixing anyone else's. And the short story is that talked to my wife about it and figured how hard can it be, and quit my job and cashed my 401 out, not knowing anything about financing or capital investment or any investors. And I went to work, and 6 years later, we had 4,000 subscribers. We had expanded into South Houston. We had expanded into south of Beaumont. We had we began, and I got a little ahead. We'd begun the journey with fixed wireless, which was far better than DSL or cable or anything that people could get at the time. And I mean, we basically had a bidding war of people trying to pay to be first, because we were going to the places that people wanted to live, not where they had to live. And the normal cable provider or whoever goes to the city because that's where the density is. And when a new neighborhood went in, we followed in and we became their internet provider. And we just kept that model going. I ran that for 6 years and then sold for a handsome profit and took a little time off. And now, again, met Justin through my wife, their family, and he and I started talking, and then met John, and here we sit today.
Thank you. Thank you, Cody. At this time, we've talked, most of you have heard this, most of you have seen the deck, the numbers, some of you are familiar with the space. We talked about how our strategic plan is to start into the Northeast. which is near northeast Texas, where there's, and in Texas, which everybody knows here, there's no regulation. There's nothing stopping us from putting fiber in these places besides, having a bond or insurance basically, and call them before you dig. What we've done in the recent months is Hal's joined is we're going to paint the picture for you and show you what opportunities lie in northeast Texas, in the Tyler, Athens, Chandler area, and also, the second part of that strategic plan is to, once we're able to break ground and get moving, is to actually start in the southeast near Beaumont, Crystal Beach, and where Cody's old business was, and move to the middle. The difference in the plan today is that number one, Cody has a non-compete that expires in January of 25. So basically 3 months away. And that's one of the reasons why we chose the Northeast. Plus it had, low-hanging fruit that we could access with no competition and no fiber connection. That's right around the corner. So the market's opened up for us. And with the program that Hal's about to show you, we'll be able to see the opportunities we have. Okay. So Hal, at this point, if you could share your screen. Yep. Okay.
Sec, guys.
Yeah.
Okay, I need to be enabled to.
Yes, you do.
Host
Multiple.
Okay.
It's fixed.
All right, cool.
Okay. There you go. Sure.
All right.
It's not. There it is. Double click in full screen mode. Yeah.
Let's see. Let's set it.
So double click it, but
Oh, this
They're not
won't.
gonna see it.
Okay.
They won't see it full screen. They can
Yeah.
do that on their end.
okay.
Yeah, this won't.
Okay, and hopefully everybody can see the screen here. Go ahead, Al.
Yeah,
Yeah, we can see
so these are a couple of markets that Cody and I identified, more Cody and Justin before me, but went through and pulled some data together. What you see here on the screen it represents roughly 65,000 homes that are these little green dots here. Green means fiber. I'm sorry, no fiber. Red means fiber. So there's a couple of dots in there. But out of all 65-ish thousand homes, there are only about 2,000 who actually have homes that have access to fiber. So these are just some of the cities that we've identified to go after first, but to kind of give you an idea of the potential opportunity. This is what it looks like. It'll take a second for the screen to populate. There's quite a few of them.
That's still impressive.
Yeah.
And I've seen it.
So there's, this represents about 370,000 homes within this area that do not have access to fiber. Some of them don't even have access to DSL or cable. They're satellite only. Now, I don't know if it would make sense to go after those because those maybe acreage,
Yeah, they might be farm homes.
farm homes, things like that. But I guess my point in showing this is that there's definitely an opportunity. Nobody's focusing on these rural and tertiary areas. In my experience, you end up with a bunch of people that are fighting over the urban, suburban, and what I call sub-rural areas of the major cities. And as I mentioned earlier, back in the dial-up days, I saw a lot of guys do very, very well focusing on these smaller markets and owning the market. Because the opportunity here is you kind of become that rural player that goes and builds these cities. You end up with 60, 70, 80% uptake in these areas, and then somebody comes along and wants to buy all of them and roll them together.
Right. And we've spoke about something in our private meetings or internal meetings, is that what this service area does basically from the northeast to southeast, it aligns us and pushes us up against the Houston other provider service areas, and Cody and Hal, y'all can speak better to that than I can, that aligns us for a strategic buyout in the future, whether it's 3 years, 4 years, 5 years, or sooner. But again, going back to our plan right now with the money we're looking to raise, we forecast to be at 10,000 subscribers in 18 months, which is just the beginning. There is a tremendous amount of opportunity here. It's a matter of, we have to get the money to be able to go start drilling so we can start putting, getting customers on and making this business cash flow. And Cody, Hal, please add to this so I don't.
Yeah, so to give you a realistic, something everybody remembers on what Hal just said about the tertiary market. If you remember in the 80s and 90s when cell phone companies were coming out, you only had service in the big cities. You only had good service, I should say, in the big cities. And if you then it drifted into the highways, the major interstates. And then when the technology upgraded and they went back to the cities. And then they went out and they tried to build a little more and a little more. And it's taken 30, 40 years for you to have service basically everywhere you go. And in the meantime of that, there were hundreds of small carriers that started up and filled in those gaps. And this is very similar to that, where you had Primeco for people around Houston, and Aerial Wireless and Centennial Wireless and even Cellular One. And they were powerhouses in their particular markets until they got too big and someone like an AT&T or Verizon or GTE MobileNet said, you can't be there anymore. We have to have that. And so this is very similar, because right now you get fiber in Dallas, you get fiber inside of Beaumont, and you get fiber inside of Houston. As the map shows, very few other people have fiber. And that's what we're looking to solve.
We can speak a lot about to this. The last meeting we did, we talked about how this worked. We'll bring up a time for frequently asked questions at the end here, because we're not talking a lot about how the business works, but it's a very simple to wash, rinse, repeat type situation. Hal, a question for you.
Sure.
You looked at this the last couple months, you looked at the financial modeling, you've spoke with me, John, Cody. If we're able to bring in the capital here and what our strategic plan is, along with you being involved in it, what do you think our chances of success are from your experiences? What kind of uptake did you have in the past, or similar to what you see?
Yeah, the areas that, I haven't dissected all the green dots on the map. I've looked at the 9 areas that have been identified thus far. And there's a high chance of success, because I have a bit of a stupid saying, say that, if it walks like a duck, talks like a duck, it's a duck. And, these areas look very similar to other areas that I've seen other providers build. And as I mentioned earlier, seen 60, 70, some 80% uptake by the demographics, the density, the competitive landscape. I feel very positive that there's going to be a high level of success in these areas.
Straightforward operational issues. You can get the major bulk carrier. You've got the large pipes that are coming from the national providers.
Mhm.
They come to enough of those regions that you can hub off of it.
Mhm.
The drilling out and laying the lines,
Mhm.
the pass-bys,
Yep.
is logical.
Yep.
This is not cutting edge technology. This is tried and true, been laid
Mhm.
many
Yes.
places.
Yes.
The availability of inventory, both switch gear as well as fiber optic cable itself, is readily available at reasonable prices.
Yep.
What are the issues? What are the operational issues? People, drilling equipment?
Both potentially.
Okay.
People are always a challenge, but Cody and I both have been in this industry for 10 plus years, and know a lot of people, and getting the right people won't be difficult, I don't believe. If we're just starting off with a clean sheet of paper with no experience, could be hard.
The most challenging piece of this, the people. It's not the business opportunity. It's not laying the cable. It's not getting the cable. It's not drilling machines. It's hiring the people doing a good job laying it
Yes.
in the neighborhood, so to speak.
Yep.
And then there's a group of people that come along and connect everyone. And then you have service folks that are actually making sure they're getting billed right.
Right.
All of those are people, they're people challenges, but solvable.
Yeah. So, that's what I'm excited about this business, is that, I look at, Cody and I with our experience, although it's fiber to the home, experience, it's different,
Mhm.
Cody's got more of the rural, I've got more of the urban, suburban areas. But it's definitely a case of 1 + 1 = 3. And the inexperience I have in doing some of this, Cody brings to the table, and vice versa. So I believe that there's.
And I know that predominantly this is rural, but there will be some small commercial.
Oh, yeah, for
buyers
sure.
as
Sure.
well
For
Yeah,
sure.
yeah.
For
In
sure.
these communities. So
Yes.
it was not mistaken that it's only rural, it's small businesses.
Yeah.
Yes. Yeah.
Yeah, it's-
And there's, within all this, there's plenty of dense areas in this map they're showing here. I think a way of simply putting this is that these are, which I'll have you respond to both Code and Hal, is the problems that will come about, is all problems y'all solved.
Mhm.
Okay, so you're very familiar with,
Yes.
and Cody, it's been a couple of years since you solved your problems. Hal, it's been a few months. Okay, and both y'all took a business from 0 to something very successful, and was able to see that it was scalable and ran. Okay, and so Cody, Cody, I do want to ask you one thing here. What was your typical initial take rate when you went into a new area in the rural side? Because we know, we've heard about some of Hal's experience, but some of these people haven't heard that. What was your initial take rate? And if, for everybody that's listening here, just to make sure here that we passed, when you go in and drill an area, you're going to go and drill through it, lay conduit, and at that point, you're automatically signing up people, and you'll get some takes and some that won't. And so the take rate or percentage is what I'm asking on the experience here. So Cody, what was your initial take rate in the first 30 to 60 days after you lit it up?
So our initial take rate, whenever people knew that we were coming to their neighborhood, was usually 50 to 60%. And that was on the pre-sign up. Once we came in, they talked to their neighbors, that went to 70 to 80%. Now, there was always holdouts. There were always, somebody may have been in a contract with some other carrier. But when we went into a neighborhood that did not have any service, that did not have another option, as this map's pointing out, we saw no less than 70% within the first 4 to 6 months of being in that neighborhood. And then usually by year 2, we had, I don't want to say 100%, but we had 90 to 95% because we were the carrier. And to give you an analogy, if everybody on this phone right now was working off of their hotspot from their cell carrier, and that was all you had, and then someone came into your neighborhood with this, I don't want to say there's not an option, but you would scramble to get it. There would be a sense of urgency for you to say, no, I need that right now because I need to conduct business, or I need to do schooling or telehealth or whatever it may be. So that's one of the reasons why the take rates are so high, is because it opens doors for people that they have never had before. Because when you're in a community and everyone's running on a cellular hotspot, it drags the cell tower down to nothing and no one can do anything. Whereas when you run a proper internet network into a neighborhood, options open up all across the board.
Yeah, the most common question you're asked when you build areas like this is not how much or what is it, it's when. When can you get it to my house?
And we spoke about this on the past in the previous meeting as well, is that the markets we're going into that don't have service get a high take rates. Now, we've also spoke about markets that have cable DSL that are very low, performing. And, even in those markets, your take rate is still extremely high. And we've spoken to banks that are heavy in this industry in the Houston area. One of the banks was Hancock and Whitney. We spoke to one of the senior reps over there, and how's that experience for dealing with Hancock and Whitney as well. And they told us, one of the senior VPs of the bank told us, we love going against cable and DSL because we always win. And so, Cody, how can you think about kind of, if we go into those kind of markets with that type of competition, what type of, speeds are you going up against, and what are we offering a difference? So,
well, there's a difference in marketing the speed and actually delivering it.
Right.
We've seen it over and over again, especially with Comcast. They even try to do their 10G network and then attempt to market it as a 10 gigabit network, and I think the FTC kind of shut them down on that marketing. But long story short, the absolute best competitor for us is Suddenlink. Suddenlink is awful, and a good portion of what you see in the green areas is Suddenlink. They don't have the money to upgrade it, and they band-aid it over and over, and people cannot stand them. But you know, Comcast is a little more difficult. It takes a little longer to get to pry customers away from Comcast, because you know they're used to their TV and their phone and all that kind of stuff. But it's not impossible, and it's a little bit slower uptake curve. But you know, the picture perfect scenario would be what I see here, which is no fiber, cable co being Suddenlink.
Or something similar. And Cody, on the speeds that you've seen in these areas for like Suddenlink DCL cable compared to what we will deliver and what we're offering, that is, what are those speeds?
Yeah, the top plan that they claim that they offer is going to be 1,000 megabits or a gigabit as it's termed. Our basic speed will be 2,500 megabits or 2.5 gigabits. So we'll be at 2.5 times the best speed that they could possibly deliver under ideal conditions. But as Hal pointed out, one of the reasons why when I drove these towns, walked into businesses, talked to people, their internet is off more than it's on. When it is on, they do not get the speeds. They can't watch TV. They can't do the things that the claim is made. So it's I don't even know the word. It's the fact that we bring them something that is going to actually function, because we're putting in state-of-the-art equipment. Nothing goes faster than the speed of light. So fiber was actually generated for communications, where cable was not. Cable was meant for TV, and they've sort of hotwired the cable plants to do internet over the top of that. So there's I don't really know how to put that into without technical talk, but basically it just works. They're going to get what they pay for, and it's going to function every day.
There's no reliability issues. There's no latency issues.
Yeah.
There's
not with fiber
issues.
optic.
Not fiber optics. And we spoke about earlier. We said that, you know, it's not cutting edge technology. Fiber isn't. It's been around a long time, but in these areas, it is cutting edge technology. You know, what we take for granted here in the Houston area, in the Woodlands area, and East Coast area, wherever you're from today, it's cutting edge technology. It changes lives. And we all know that, but I want to make sure to say it for the video purposes of what we're doing today here. In a few minutes, we're going to do some questions, but John Dennis of Wood Rock Capital is the individual leading the charge on the formal raise for Excitant Fiber. I want to give John a few minutes to talk about our raise, our structure, and the financial side of this, and then we'll open up questions, because we could talk for an hour about this, but we're trying to cut to the chase here and be simplistic about it. John, over to you, man. Okay.
Yeah, the idea is to raise an initial $6 million to get to start the operations of the business with 2 drilling teams. The structure of the financing is that it would be preferred equity over the common equity being put forward by the partners. We would like to break escrow at $4 million and get the business going while we continue to finish out the balance of the 6. We have built a 10-year projection model that suggests that additional capital is going to be required, literally based on success. The need to buy equipment, buy drilling machines in advance of the cash flows coming from the subscribers means that as long as you're growing, you actually need cash. As you're going into new neighborhoods, new tertiary markets, you need cash because there's simply a working capital requirement. The minute you stop drilling, the subscribers start to fill in and you actually get to a positive cash flow scenario. So the risk is pretty low, and we've tried to come up with an amount of capital that would get this business to, in the event of an absolute stop, meaning they don't drill anymore, there's at least a business of enough size that it actually you've got a cash flowing business and you could just stabilize it. The reality is you also are setting up situations where you have opportunities to invest cash as the team demonstrates their ability to deploy it, drill the right of ways, lay the line, lay the equipment, lay the boxes, and then actually connect those pass-bys to the discrete subscribers. So we've tried to find a middle of the way risk between growing too fast and allowing the business to actually have enough scale to be able to grow efficiently. There is effectively 3 million of that 6 has been circled by a group of individuals. And the magnitudes are anywhere from about 100,000 to 500,000 bite sizes. We're looking to complete obviously all 6, but we need another $1 million or so commitments to be able to close on the $4 million initial break. It's a convertible preferred structure. The company is an LLC, so it would be in Series B units. There's a liquidation preference. There's a slight preferred return. And if you think about where you ultimately get your liquidity, I think you have to look to a 3 to 4 years into the horizon when the company would be at a scale where you could recap out some of the early investors. But really, I think at that point, you would probably want to be keeping your money in the deal and because of the internal compounding. I don't know what else to say. It was just kind of a quick and fast version.
No, there's just, there's a lot of financial to go to on this side of it. One thing that I said to probably all y'all at one time that I want to say for video purposes to make sure we've said about it, because we started off in a different way today here is, I'm sure everybody's thinking here, if they haven't thought about it already, is how hard is it to do to 10,000 subscribers, which is where we're considering critical mass scalability. Okay. And being bankable at that point as well, which we say we're forecasting is going to be in the next 16 to 18 months. And I'll let Cody and Hal add on this, but I had to dumb this down because I'm in aviation, construction, other things. And so I had to learn this business in the last couple of years. And I'd explain it to my kids and my woman. And the way I explain it to them is a very simple theory. We're starting off with 3 drills at about $500,000 a piece. Okay. These drills have a 3-man drilling crew. Each drill can drill approximately 400 home passes per month. So that's about 1,200 home passes per year, per month total together. Over 12 months, that's about 14,400 home passes. With our forecasting, our modeling, we're saying and forecasting that our take rate is going to be below 50%. When we both heard experiences from people that have been successful at doing this in the recent months and years, where it's been 60 to 70 to 80%. So we've prepared a very conservative model here. Woodrock Capital and John and led by John Dennis, they did the modeling. Cody and I assisted. I've spent a long time with them, but they have done their diligence to make sure that we are conservatively done. Hal has looked at it. He spent time going through it. He has also signed off on our modeling. Okay. The numbers we provided, the projection we provided, they're conservative. As y'all can see, the geographic area and the opportunities we have are real. It's really about the capital to go take them on and make sure that we're able to get to those markets faster before anybody else does. Because once we're in the markets, we're going to own them. Okay. And it's also for the capital to continue to grow, which comes from once we're scalable, once we're bankable, being able to use less equity money and use more debt, which is in the model as well. Okay. So
the fiber cable itself and the switch gear are all highly financeable. The company just has to have the trailing 12-month cash flow, free EBITDA from its subscriber base to be able to get the financing in place.
So what's the valuation for this round? Because it sounds like this is all going to be equity, at least generally, right? Or did you say it was a convert?
Yeah. It's a convertible preferred like model done in an LLC legal entity. So you have A and B units. The founders will be A units. The new money coming in will be the initial capital. Bulk of the capital will be B units from investors. We'd like to raise $6 million on 35% of the company.
Okay.
So,
Okay.
now,
And it's a convert is controlled by the lender, or is it your discretion is if it converts or is it paid back?
it's an equity, so it's a convertible preferred equity is the model. So it's not a debt structure.
Okay,
That is how we have modeled it out. It could be structured as a debt structure, but it would have to have enough term in it. I would argue something like 3 years.
right.
5 would be better, but at least 3 years. The
Yeah.
problem with any type of a debt structure is at roughly 18 months, when there starts to be free cash flow from the subscriber base, a bank would have to look at some sort of, the bank would want a senior position on all the equipment. So
Right.
whatever the debt instrument might be, would have to be,
Gonna be
junior
subordinated.
to the bank debt.
Yeah.
So I think you really get to effectively the same place if you just call it equity in the first place.
Yeah, I think you're right. Okay.
And then there's,
That's what I figured.
and then there's just an understanding among the investors that at a certain free cash flow point, and I would argue that if you follow the plan, if you go through the projection model, I think you really need to get out to 3 years from the date of funding. So that's 25, 26, 27. At the end of 27, you have enough free cash flow where there's actually the ability to do some sort of a recap that would take some of the initial money back out, or what in our slang term we refer to it as take the original nut out.
Right, and if I heard you correctly, I apologize, is you said 6 million gets you about 33% of the company?
Yeah, 35 is what we were proposing
So roughly a 20-something, 21, $22 million valuation.
on the whole business, the
Yeah,
total
yeah,
enterprise
yeah.
value. Yes.
And that's pre-money.
Pre-money's in roughly in a 10 to 12.
Yeah, okay. Okay, that's reasonable.
And since the B units have a liquidation preference, they really own everything until there's substantial free cash flow.
So do you have all these terms papered yet, or is it still?
We have a preliminary term sheet that outlined the primary terms, but we
Okay.
can certainly send that to you after this call.
Yeah, and the only other real question I have, I don't want to take up everybody's time, and I've got a hard stop here in a bit, is the hardest thing I'm trying to get, and I'm not super familiar, though I know enough about this business to be dangerous, is the liquidation, right? And how much of any kind of control does investor have to liquidate, either to sell off, I guess, his shares at some kind of discount, or if he doesn't want to wait, in the models, it looks like it's kind of a 10-year model or 9-year model. And that's kind of long for me, at this point in my life. And I'm sure a lot of the guys that I've done deals with, that's just a long hold, right? And I know it's probably the nature of the business. So I don't need per se an answer right now, but just if there's a mechanism in which individuals can kind of control somewhat of their own liquidation fate, if you will, that would be helpful. And I don't know if you guys even thought through that, but it's just a long haul for a lot of the appetite of at least the investors that I deal with.
Let me answer several of the questions in there, because I think we can give you a good answer right now.
Okay.
First, the 10-year projection model is we really wanted to see what the compounded free cash flow being reinvested back in the business would look like over a 10-year horizon.
Right.
The model we think is actually quite conservative in the cost and the uptake. So those are the two biggest drivers. Cost of the equipment, cost of drilling is one set. Those are your drilling costs, your setup costs. And then the second biggest assumption is the uptake rate. You drive a piece of fiber optic in the easeway in front of someone's house. How many of those houses actually connect? Those are your two biggest drivers. If we have any kind of mechanism, so that's really the reason why we needed to have a 10-year model to sort of understand the compounding. If we have a debt instrument that has to be subordinated, that would need to be subordinated to any bank debt. And if it's less than 3 years, less than 1 year, we have to actually treat it as a current liability. At 3 years, it's still in the audited financials will be listed as a liability of the business. And that will cause the banks some concern, and even to when it's subordinated, because that's an impending refinancing that's required by the company. So a debt structure shorter than 3 years really creates substantial financial limitations to the business in terms of what it could borrow for growth because of the impending debt retirement. So I think a debt structure really doesn't work. I think an equity structure, but an equity structure that gets you out to a certain EBITDA threshold is actually the better mechanism. In an equity structure that has a put, that is the ability for an individual shareholder to say, I want my money for these units. That also becomes something that has to be footnoted. And depending on the nature of the put and the rights of the investor, that put can look like a debt repayment.
Right.
And that becomes an issue in the eyes of the senior lenders.
Right, and is there already a predetermined prep on that?
I think the answer is we're suggesting 6%. And that's really a time neutral idea.
Right.
And so the idea is that it gets you away from it, creates a time neutral position. So that really what you're saying is I'm looking at the value of the business in a horizon when there is an adequate amount of EBITDA to do a recap.
Okay.
And I think the amazing thing about the density of this market is we think it happens actually fairly quickly.
Right. Yeah,
It's not gonna be, it's not gonna be 10 years.
And I would say that's where we think somewhere between, we're conservatively saying in the 2 to 3 year horizon.
Right, and is the valuation on EBITDA what around, I think I took a quick look, it was around 10, a 10 multiple?
Well, the valuation multiples are the valuation metrics are generally against actually connections.
Yeah, that was my question.
Yeah, so at 10,500 per connection is for a business that's at 3 or 4 or 5 times the scale of this business in 3 years. Discount that back to say 5 or 6 grand per connection. At 10,000 connections at 5 grand, you got a $50 million business 18 months from now.
if not more.
Yeah, if you look at,
I mean, I'm just using simple cowboy math.
Worst case.
And that serves where a private equity firm, traditional 10-year private equity structures suddenly make sense. And that's where we take out the Series B investors today in a three-year horizon, is that they get refinanced out, or literally on a case-by-case basis, they get the option to either stay or be cashed out. It'll be really binary. You won't get to take some of your money off and keep some in. The institutional investor will say, if you're out, you're out altogether.
Mm-hmm.
Yeah.
But at that point, and I realize your point about your horizon, your personal investment horizon, the question will be for you at that point is, you have no more investment. They're putting all the rest of the capital in and ensuring the growth of the business. They have more wealth in the deal than this group of investors will have. The challenge that you'll face is you won't have any ability to drive any decisions on an exit, because that private equity firm will control the exit strategy.
Yeah.
And they have a 10-year horizon.
Right.
With our current plan, to add to this in a simpler way, is that, we've got a 9-year forecast here.
Yeah.
But both businesses, for both Cody and Hal, that they were involved in, they both seen successes in a much quicker time period. Again, going back to conservative, seeing out the model, seeing the compounding. This is, 3 years, 3 to 5 year, and it's 18 months to 10,000 subscribers, and it's reinvesting all capital that we have available. It's not being, utilized for either distributions or repayment or buyouts or so forth, back to growth. And then
Yeah, no, I was just looking, I took a quick look at the deck before the call. And I guess my real question was, how much does a customer numbers drive the valuation versus EBITDA? Because when you say, in the deck, it shows a projected enterprise value of like 330 some odd million, I can't remember. And at the end of like 2030.
Yeah, in 10 years.
Yeah, and so it kind of vetted with the 10x EBITDA, and that's why I was asking you.
Yeah.
Asking you if that's really driving it, or, if it is customers, which is, kind of obviously makes a little more sense to me. It just is a different valuation is all
Yeah,
I'm saying,
so-
right? You're looking at two different valuations, which then drives
And let me tell you where the differences are
Mhm.
between the two. An EBITDA multiple valuation is a forward-looking valuation in general on the forward growth of the business, the continuing growth of the business. The 10.5 for a large established area, $10,500 per customer.
Mhm.
And I'm discounting back to where we will be at 10,000, not 50,000. At 10,000 customers, so we discount off of 10.5 just because of the scale of the business.
Right.
That is a going concern based value. And that's where, I'm just cutting it in half and saying use $5,000 or $6,000 per customer. And you still get to a very nice number.
What do you have to be at to get the full 10.5 in terms of scale?
I think you have to, in my opinion, then I'm gonna let Hal ask. My opinion is you've got to be in the 25 to 30,000 customer scale. Tachus is at 50 today and still filling out with its in-place infrastructure. In our case, we get to 50 over in basically 8 or 9 years, but more critically, we get to 25 in 29, which is the 5th year.
Right.
Yeah, I would agree with John on that. I mean, really, anything less than 10,000 customers is not, nobody really looks at those. It's kind of like once you cross that threshold, that's when it gets interesting. But getting up into that 25, 30,000 number, that's when people really take a serious look at you.
Look, our other folks are doing this same rural tertiary suburb market strategy in other parts of the country. So this is not rocket science. This is taking advantage and doing it in Texas with folks that have worked in Texas.
Right. Because it doesn't seem like outside of capital, there's a large barrier to entry here.
There's a large number of small players that handle a small community. And that is a lot of what these guys are going to be going up against.
Right.
In a city, you don't have small players, you only have the big players. So they're trying to bring a more urban-like expertise and execution to a market of weaker players. Does that make sense?
Yeah, they don't have the sophistication or the experience that Cody and Hal have, or that I have in scaling businesses, running businesses, or the financial capacity to do the things. We met with these individuals in markets. Cody knows a lot of these, Hal knows some of them as well. And they're just growing out of cash flow like Cody did before. They have cash flow each month, they spend it and they grow. But outside of that, they're not able to grow faster than that because it's just too complicated for them.
So on the cash flows, are you assuming that just the 6 million raise? I just pulled it up.
No, the model reflects an incremental raise in the around the 18-month horizon. So there would be some dilution. We would expect that the investors that wanted to continue to invest would have the opportunity to, but we also believe it's a very different investment thesis at that point. You've proven the markets, and it's really just expansion financing at that point. The ability to do a transaction where money comes off the table, I think that would be premature, but it's not impossible. It's just going to be, to the folks that want to take money off the table, there would be a meaningful discount.
And the market, then to add to John's statement here from working with John's team, the first 6 is to prove out the milestones, prove out the markets, prove out the management team. And then I believe it was actually 12 or 13 months, give or take maybe 14, where the next 6 came into place here. What that would do is it would get us to the 10,000 plus subscribers, which is the first true hurdle to overcome after getting cash flowing, so that we can be bankable. And at that point, less dependent upon equity and cash to go to grow and move from there. That helps out, Paul. And anybody else that has questions, please, this is obviously question time. So please bring them to the table because we've left a lot on the table, purposely. And I know the call is getting long here, so I know people have other things they need to do, but please, for questions, please.
So maybe I'll just get with you and go through these financials at some point in a little more detail. Just because I'm looking at the projected cash flows right now, it's Series A only. And it shows the Series A at 6 million, but it doesn't show another 6, or at least I'm missing it potentially. Or maybe it's divided up in a bunch of other categories here.
It's not visible in the deck.
Yeah.
I need to show you through the model.
Okay,
So we can break off on a side call, but it is figured in the financials along with debt at around the 16-18 month mark. Okay.
Okay, guys. Hey, I got to jump, guys. Great to talk to you. Sorry, I hope I didn't monopolize the call here.
No,
not at all.
Questions are good.
All right.
Caesar, I can't see anybody that's here right now still. Who do we have here? Jordan, any other questions y'all have? Because we can talk further in depth about the operational strategy, the business experience, but what kind of questions does anybody have here?
I had one execution question.
Sure.
So someone had mentioned, the internet, like the switching network hardware and stuff, is very easy to finance or lease, and I'm very familiar with that world. But then you mentioned separately buying the drills, but presumably at some point, like, you stop using these drills that you own after you've reached the markets you want to reach. Is there not a model to like lease or use the drills without ownership? Is that why they have to be purchased?
Yeah, the trouble with leasing drills is that the cost is astronomical due to the maintenance that's needed, and no one wants to lease you something like that. There's ongoing maintenance that we have built into the model for those drills, but whether it's Ditch Witch or Vermeer or any of the companies that do that, you pay, I can't even remember. I was going to try to pull up some real numbers for you, but it's like 6 times the cost per month to lease it as it is to finance it.
And
Gotcha. Okay.
And Jordan, to add to that, so some differences here, so I'm gonna add some color to that, is what Cody did is he bought his drills, he ran drilling teams, crews, 3 per drill, and learned that, figured what I call, I'm not gonna say it on the video, figured it that out, okay? Whereas Hal, a lot of what you did, if I'm not mistaken, a service provided y'all hired drilling companies to come in and do your drilling, right?
Outsourced.
It was outsourced. Now, a lot of companies do that, but what Cody had found in the years he did by outsourcing, your expenses were higher, you're more red tape, and it was harder to grow as fast or to be as flexible, not as fast, but more flexible.
And in short, it costs between $3 to $4 a foot. If you do it in-house, it costs, what'd you see, 10 to 12 a foot?
Industry average.
If you're doing it,
15.
yeah, so between $10 and $15 a foot if you're doing it subcontracted. And that included the drill and all the labor and all the things to do it. So by doing it ourselves, we can scale as large as we want at 1/3 the price.
Gotcha.
And something else, Jordan, is technically speaking, the model isn't showing we're never going to stop growing. And, there is a situation where that can happen, but it is going to continue to grow. And until there is a proper exit strategy, or the acquisition strategy on the side of it. So the drills would always be to put to work and be working. If they did become obsolete because they're outdated, new technology came out, or there's newer technology that's better and more efficient for us. I'm not right, Cody. There's still a very good market to sell these drills today. And it's very hard to, they're available, but they don't stay available long. Okay. So there's a good market to be able to move those, is what I was trying to get to.
Right. There's liquidity in the
you.
drills, and there's financeability of the drills. You just don't want to lease them. You don't want to rent them.
Yeah,
That makes sense. I mean, it's a very different piece of hardware than the switches. So I can see.
Oh, yes, most definitely. It's a construction, it's more like a backhoe, so, per se.
Construction equipment versus electronics.
Right.
Yeah. Thanks, Jordan. Appreciate it. And any other questions from anybody else today? Steve or Bo or Caesar, did y'all have anything today? Or I think we had some people drop off, I know, as well here. No more questions? Did Cody and Hal and John, did we cover everything appropriate to y'all's opinion? I mean, I know we went in a different Wade today.
We did.
Okay, so how would you like to add anything to this from what your experiences have been?
No, just looking forward to getting started,
Yeah.
because we either do it or we watch somebody else do it.
All right.
Let me offer this. We will circulate the term sheet that we discussed to everyone by email. And I'll be copied on it. I'll send it out, or Justin will send it out, and I'll be copied on it. Happy to have any conversation you would like to have about the projection model or the return scenario. You'll see in the executive summary, we actually built out both of the $6 million financing rounds. And we also built this a model where you just raised $6 million once, you never raised another dollar. And then to sort of give you a sense for how that would cash flow out and how you would get your money back out of cash flows. So happy to walk you through all of that and provide whatever comfort and questions we can answer.
I don't have any questions, and my only comment, I guess, because I asked, well, Justin asked me to join this call because I have a background in cybersecurity. I own a cybersecurity company, and we literally have a fiber optic regeneration station right here. As all of you know, and some of the fellows on the call know, fiber optic has to be regenerated after so many miles. So you have to have regeneration stations. And the way Summit IG has done it here has been along the freeway and been able to really scale quickly. So what I told Justin in previous years that you guys are onto a very incredible opportunity. If you're picking a very unique piece of the pie, sounds like Cody is kind of a subject matter expert in the area, as well as Al. You guys have a good team there. So my 2 cents on it is that this seems like a very viable opportunity. You seem to have put together the right team to do it. And really the financing, to Al's point, the quicker this happens, I have no endorsement and I get nothing out of it. I'm just another investor speaking here. But what I liked about this opportunity Justin presented is that I saw that there is a lot of robust foundation on this. I do cyber. And one of the things that we can't get enough of is fiber optics, because I do it for the federal government. We do it on the classified side. So we have dark fiber that we light up based on where the government needs it. So that might be a consideration for you guys in the long run as you are laying down these pipes. Identify those sites that are what we call black sites, and see how those both government contracts and commercial contracts may lay out. We have a top secret clearance entity. Happy to help out, but as an investor, I see the great potential that you guys have here. No endorsement, just giving you the facts. Fiber optics here, we can't get enough land. I have 15 acres that people are fighting over because it's data center land. So you guys are on something really good here. And again, to Al's point, raising the funds is the only thing holding back the progress. So didn't mean to kind of come up as a pitch, but I've known Justin for a long time. He's annoyed me for many, many years on the most stupid things in the world. This is one of the actual good ones. And you got a winner here, Justin. I just want to be, I'm a Marine, so I speak in Marine terms. He is annoying, but in this case, you're actually speaking among wise men. You surrounded yourself finally with smart people. So I think you got a winner.
Well, we're all annoying till we reach the success, then everybody says, well, great job.
No, you're just annoying, but you got a good.
Yeah, when I see you next, we'll talk about annoying, but no joking. Thank you, Cedar.
I love you, brother. I love you, brother.
But
that's why.
Go ahead. Somebody else have something?
George is
Okay. All right, we're gonna wrap up today. The last thing I want to state to this is that, what we've already said is that every day we don't get in the marketplace, we're losing market share. There are competitors going to go in these areas. It is vital that we get started. This isn't a 5-year from thing gets started. This isn't a year from thing gets started. This is something we need to go to seize these opportunities. We need to be able to go do this. We need to do this sooner than later. And we've had, everybody was distracted in the summer. We lost some momentum here. Obviously, we know we've got Hal added to this. Cody and I are engaged. My back office team's engaged on this. There is a lot of money to be made and a lot of success to be made in this company. And we need to get the bright people around us so that we can get started. Okay. And then thank you all for coming. I know that, hey, as Cedar said, I did annoy you and I'll do it again when there's a good opportunity. And I'm not going to apologize for it because it's a damn good opportunity. So thank you everybody for coming out today. and I know we'll speak soon. Have a good day.
Thank you for listening to Excitant Fiber's second capital raise session. We appreciate your interest and time. If you have any questions or would like to learn more, reach out to us.